freedom isn't the result of wealth, it's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I'm here as always with Adam Penn. Adam, hi.
Hi, Dustin.
How are you doing today?
I'm doing good. It's a new year. I'm looking forward to kicking things off. It's funny, I don't set my goals for the year for like another month because I do the kind of offset quarterly goal setting. So my goal setting calendar doesn't end for another, it's the beginning of February that it resets.
So remind me why you're offset. We've talked about this before, which by the way would be a great time to plug. I think it was one of our very first episodes.
Yeah, I think it was episode 1.
Episode. Yeah, so we'll make sure a link to that makes it in the release notes. But remind me why you're offset a quarter or offset it's offset by a month, right? Like a month later?
Loosely a month. It's just so that I don't do goal setting at the same time like a quarter turns over, because things tend to be happening then, like business goal setting or like closing out the year or travel. I don't know. Things just seem to happen on the end of a real quarter. So my personal goal setting is offset from that, which seems to work pretty well. But that means every year I kind of reset in February.
Right. That's like how in software as a service, most of the time, most companies their fiscal year ends January 31. And so that was always very confusing. What's that?
That's my birthday.
It is. Happy early birthday, by the way.
Mm-hmm.
Was that like next week?
About a week from 8 days.
Yeah, be close. But yeah, so they're always offset. And so it's very confusing because it would be like we would spend the vast majority of, say, like year 2020, calendar year 2020, the vast majority of it would be fiscal year 21. It was always very confusing.
It is confusing.
I really, really hated the January 31 year end for financials and everything. But there's a reason. I think it has, I don't know if it's like year end sales or something like that, but anyway, I can understand offsetting a quarter, but offsetting a month was always very confusing. And I'm easily confused. So it was never a good combination. Yeah. Well, anyway, speaking of things that people can get easily confused about, that's probably a halfway decent intro into this No Investor Left Behind latest episode. What we got today?
Depreciation.
And bonus depreciation, right?
And bonus depreciation. But depreciation even in and of itself is confusing, right? You buy an asset that, what's one of the reasons to buy real estate?
Well, the tax benefits.
No, appreciation.
Oh. Well,
and it's a depreciating asset according to the IRS.
It's true.
So you go buy this asset that's going to, supposedly appreciate, be worth more in the future, and then the IRS says, you can write off a certain amount of that year over year. What's the standard schedule for residential real estate? 27 and a half years?
27, yeah. 27 and a half.
It's 27 and a half.
Yeah.
Yeah.
Which makes a lot of sense, right? That's a very logical number that, obviously was picked for completely 100% logical reasons.
Mm-hmm. Yeah. And not the land, though, because that can't be depreciated.
That's correct.
Which is arguably, it goes up in value too, but I'd almost say less than the houses. I feel like land doesn't normally, I'll see raw land sit at kind of a steady rate longer than I think house prices fluctuate.
Yeah. Land tends to track just baseline inflation more so than anything else. It doesn't typically move with the housing market, but it's more correlated to just general inflation.
Yeah. So anyway, we wanted to talk about depreciation and bonus depreciation. As you can tell, I don't think we have an outline for this, but I think the general idea here is just to, we talk about it on calls, we talk about it with investors, we talk about it in deals. It is one of the tax benefits. So I think,
investors ask about it. This is a very common question.
Yeah. So I think, maybe to kick it off, and then Dustin, maybe you can clean it up a little bit. It is one of the ways we get tax benefits in real estate, right? Because it is this phantom loss. It's an accounting loss, right? So you've got, let's say you have a $150,000 house and you have I'm going to change this number. You have a $50,000 house and $22,500 is the land value. So the house is worth $27,500. That's a real cheap house, I know. It's probably out in East Tennessee where Dustin lives.
I was gonna say in Memphis, but
it could be in Memphis. So you got a $27,500 house, value of the property, the improvements to the land. That can be, according to the IRS, depreciated over 27 and a half years. So you're going to get $1,000 a year. See how I picked that number that was so carefully placed there?
Yeah, very nice.
And you're also going to have some real valuable land because apparently it's worth half of what the purchase price was in that case. But so you get this depreciation, and it's just a tax loss, right? So every year you're going to take your income, and we're not CPAs, but this is our understanding of it. You take your income, say that house made $5,000 that year, and then you can take that deduction. It's just another line item you can deduct, and it's the depreciation. And so it's one way to kind of shelter some income. Now, the second part of that is instead of doing 27 and a half years, and this is where I think a lot of people kind of get confused, the IRS lets you do what's bonus depreciation. So you can take 5 and 15-year property and bonus depreciate all of it most of the time in year one. Now, that's where it gets kind of confusing because I just said 5 and 15-year property, but we were talking about 27 and a half a minute ago. So when you go to bonus depreciate something like a house, there's normally 3 categories, I'll say 4 categories of depreciation schedules on the house. There is 5 and 15 years. So those are items that the IRS, once again, the IRS has made up these things. The government shouldn't exist to begin with, has made up these crazy freaking ideas that the certain things are good for 5 years, like LVP flooring or carpet. I might agree with them. Carpet might only be good for 5, but that's probably also something that sometimes is only good for 1 year, depending on the tenant. So you've got this depreciation item. And so what you do is you get a cost segregation study, and it segregates the costs of the building into different categories. And so you pay someone, normally, we just did one on a 20-unit building. It was $3,500. $3,500. And they go and they look at all the items and they say, carpet's worth this, tile's worth this, drywall's worth this, roofing's worth this, lumber's worth this, concrete's worth this. And they break it all apart. And then they say, this much is in your 5-year bucket. This much is in your 15-year bucket. This much is in your 27.5-year bucket. This much is land. Okay, so now you've got all those numbers. You can take the amount that is your 5 and 15-year number and take all of that in a year one write-off. And you might say, well, why do I want to do that? That write-off can then offset other items, right? Once again, we're not CPAs. This isn't tax advice. But for me, I'm able to take those losses and go offset other items that I'm earning income from. So if I made a whole bunch of money on one building, I might be able to go buy another building and take all the depreciation and offset all the income on that other building. I mean, that's my general summary. Do you want to talk about recapture? Because recapture always gets me a little spun.
Let's get there, but let's take a step back a little bit because this is it's important and it's complicated, right? Like there's a lot of moving pieces with this.
Yeah, send us an email if you've listened to up to this part 4 times before you got to this part. We'll send you a cookie.
Oh, that's very nice.
They can let us know. There's a cookie shop here in Chico that sells like big cookies. I'll send them a box.
All right, I like that. Yeah, send an email to depreciation@wealthindependencepod.com and we'll make that happen. I'm trying to think of where to back up to.
The beginning.
So there's the bonus depreciation. So there's accelerated depreciation, which is kind of the buckets that you're talking about, right? Like where you can. And this is where like bonus and accelerated end up getting thrown around a lot. But you've got the standard depreciation schedule that if you talk to Tom Wheelwright, he'll actually say that like you're not supposed to do that, right? What you are supposed to do is the cost segregation study to depreciate based on the schedule of the different items in the house.
Yeah, when you go from doing regular 27.5-year depreciation, which is kind of the go-to way to do it for most people, switching to the cost segregation depreciation schedule of everything's, segregated, then you have to file a form with the IRS saying you're changing your accounting method from an improper accounting method, the 27.5-year, to a correct accounting method. So the IRS allows you to do the 27.5 year, and most people do it, but it's technically an incorrect method based off of their guidelines.
I'm glad you mentioned that, because that's something I think a lot of people will look at this and call it a tax loophole. And it's like, well, no, this is actually the way that the IRS says it's supposed to be done. It's just they allow this simpler method. And some of that can come down, like you do have to weigh, you mentioned $3,500 for a cost seg study, right? That's a no-brainer on a larger commercial property. And that's a pretty cheap thing. We built it into, typically closing costs and some of the initial things. We're going to do this for any property we buy. For a single family home, you kind of have to weigh, are you going to get that much in tax benefits? I think used to, these things were a lot more expensive. There have been a lot of cost segregation providers that have come into the space in the last few years, and it's driven the price down. So I think it makes sense.
I hope they're not listening to me, but I normally just I get 4 quotes and I tell all of them that they underbid each other by $500 and see which one takes it.
And they all go down. But I mean, the increased competition in the space has driven down prices. And I think 5 years ago, maybe 7 years ago, whereas this a lot of times didn't make sense for a cheaper single family home, it really does now. And especially if you're something that you plan to own for an extended period of time, you'll definitely see that tax benefit. I wanted to mention that. I did want to hit again. You mentioned that this is I like to call this a phantom loss. Like the depreciation is a non-cash loss. But the beauty is the IRS treats it as though that same amount of money, like Adam, in your example, $1,000 a year, they treat it as though that money actually left your checking account. Like that you basically get credit as though that was an expense or something else that offsets the income, even though there's no actual cash outlay on your part. And I think that's one of the things that makes
27.5 years later, I can almost guarantee you the property will be worth more, not less.
For sure. But that's the beauty, right? Is that you get to take credit for what on paper appears like you lost money and you didn't actually lose any money, right? Now, again, we can argue that eventually you have to replace some of this stuff or whatever. But the whole thing here is this is now a loss. It offsets income, particularly if you're buying income producing real estate. This is big because it offsets some of that income. So I wanted to hit on that. And then also you mentioned if you take all of this up front in year one, you now have this big year one loss, right? And especially on, the larger the property, the larger the loss. The beauty there is, for one, Adam, you mentioned that can offset other income elsewhere, which is totally fine. You could also choose to not apply that. If say you only had one investment or something like that, and you didn't have other passive income that you could use that loss, the depreciation loss, to offset the income. You could just roll the loss over year to year. And then now a lot of times that's what ends up happening. If you weren't applying this larger loss to some other income, you end up having several years especially on a larger property, of completely tax-free income. Again, not CPAs. This is all very situational dependent, but this oftentimes is the way that it works out, that those losses taken in year one are so great that you can just sit there and roll them forward and they'll offset income for multiple years. And so that's, people talk about the tax benefits of real estate. This is usually what we're talking about. You couple this with debt, and now you've been able to get that. So that's something else we haven't mentioned, right? Like you can go and buy a property with 20% down, right? Mostly on the bank's money. Well, it's not like your tax loss is only based on the amount of cash you paid, right? Like you get the full benefit of the entire value. So that's one of the reasons why, if you're actually looking on a cash basis, your loss can be significantly greater than what you actually paid for the property in the first year, and then continue to use that rolling forward to offset the income.
I think a good example there is, let's say you get a 35% year one, 35% of the value year one deduction on 100% bonus depreciation on 5 and 15-year property, and you only put 25% down. If you put $100,000 down, you're getting probably more than that, $185,000 deduction loosely.
Yeah.
It's a pretty big difference.
Off of the bank's money, effectively.
Yeah.
So again, this is why real estate's really one of the only places where you have this, where you can, obviously there's depreciation elsewhere, but it's tough to pair it when you look at the depreciation benefits paired with the availability of debt, paired with the power of being able to actually generate positive cash flow. It kind of creates this perfect trifecta. On the passive income, I think we'll get into the recapture scenario a little bit here. Let's say you are an investor in a syndication. So you're an LP in a syndication and you get this tax benefit, right? Like this effectively your portion, however much you own, that flows through on your K1, you get this loss. So you can take advantage of this even if you're not doing any of the work, right? The sponsor does the cost seg study, has all of that done. The CPA prepares the K1. You get this benefit on that investment. This loss it's known as a passive loss. And so that starts getting in, and this is where, again, we're not CPAs, and I don't want to wade too far into this, but it's just something you need to be aware of, that really, this might be an oversimplification. Passive losses can only offset other passive income. There's ways around that. You might hear the STR loophole, real estate professional status. There's other ways to kind of allow passive losses to offset active income. But generally speaking, the loss you get in the depreciation loss you get from an investment in real estate can only offset other passive income without trying to go down one of these other paths. And that's probably, honestly, real estate professional status and the STR loophole are probably their own episodes in and of themselves. But just know that if you go into this thinking you're a high earning W-2 employee,
which once again, STR loophole is not really a loophole. It's just part of the tax code.
Yeah. I hate using that term, but unfortunately that's what it's become known by, yeah. Right? Like everyone calls it that, but it's just following the rules. The big takeaway from this is, if say you're a high earning W-2, don't think that you can use the depreciation loss from a real estate investment to offset the taxes, the tax liability on your W-2 income. Those are really separate buckets. So what it will do is shield the income that, say, in the future might come from the real estate investment. So the money that is sending in is going to be shielded from taxes by the loss. But that loss, shy of going some other method here, is not going to be able to offset your active income. And that would include things like capital gains and other stuff like that. So that's the biggest thing. Again, there's a lot of nuance here. All of that probably could use its own dedicated episode, but those are the big things from Adam, from all the stuff you mentioned. Those are the big things I wanted to call out.
I think one thing you called out there, and I don't know that there's a whole lot of other areas when you go here, is just that I'd like to reiterate that this works in partnerships, this works in syndications, right? It's not just like you have to own the building directly, you just get your pro rata share. So yeah, I don't know that I have a whole lot else. It even works, and this is a whole nother episode probably, so you should be writing these down, STR loophole and 1031 exchanges. The second thing is 1031 exchanges. It works if you exchange into another property, you can still bonus depreciate that next property and get the benefit. You're going to have a increased basis, so your deduction might not be there. You might not have some massive offset between the two, if your basis is too high moving into the second one. So there's that, but it is still very much a tool that can be used. And that's really what it is at the end of the day, right? It's a tool in part of your portfolio planning. And we talk about that a lot on the show. It's just that you should be planning. You shouldn't just be handing this stuff off and having someone else do it. You should be making a plan and trying to execute, and things are going to go wrong. I mean, I've had deals that have gone wrong. I've had budgets that go over. I've had budgets that come in under, right? Things happen, but it all starts with a plan, and then you work to execute on that plan. So I think this is just another tool in the tool chest.
And this absolutely, and this emphasizes, we talk often, we've got, we can go find a link to episode where we've talked about this, about the importance of having advisors that know about this stuff, right? Like someone that can help you through this planning process, and potentially multiple advisors, right? If you were going to do this on your own, the larger CPA firms a lot of times will do cost seg studies in house, but a lot of times that's a separate specialist that you're gonna want to go to find someone to actually do the study. So this is we talk often about the importance of a team and surrounding yourself with a team, and this is just yet another thing to be able. There are all these tools out there that you actually do have available at your disposal, but you really need to have the team to help you know how to use them and how to plan appropriately for your specific scenario. I don't know if you got something else. I did want to touch on recapture, because that's something that often gets lost in this conversing. That is kind of the downside. So it's very generous of the IRS, and we're thankful here that starting with the new with Trump 2.0, the Trump administration 2.0, we got 100% bonus depreciation back. And so, and for good, we had that previously and it was kind of phasing out. So the ability to do all of the stuff we just talked about is kind of now seems to be permanent, which is good until someone else comes along in the future and decides they want to change that. But for now, we're going to pretend as though it's permanent. And that's very generous of the IRS to say, hey, you can take all these losses up front. But here's the thing. If you're taking a 5 or a 15 year or a 27.5 year loss all in year one, and then you don't actually own the thing for all of those years, well, the IRS says, hey, you owe us money. Like we sort of fronted some of this for you and gave you the benefit on this. But if you sell that property after 5 years, well, you took 10 to 17 and a half, I did that wrong, 12 and a half years. My math's terrible. You took all this extra like depreciation in the future that you brought forward that you now don't own the property. And the IRS says, hey, we'd like that money back. Yeah. And so this is known as depreciation recapture, and where it shows up is on a sale. And so it's something that if you're going to be investing passively in a syndication, and particularly if the sponsor's talking about a hold period of, let's say, 5 to 7 years, and they're talking about using bonus depreciation, you definitely want to be asking the question of whether or not first of all, are they considering recapture? If they haven't heard of it or aren't thinking about it, that's a big red flag. And then second, how much it might impact the final returns, because ultimately it gets treated as like a sale, an expense on sale. So you might have commissions or other expenses associated with actually selling the property, and that's kind of the best way to think about depreciation recapture. It's the IRS is going to be sticking its hand out at the very end at the closing table, and they want to get paid what is owed back to them for depreciation that you did not use. And so it can reduce returns. It can reduce the final return of a deal. So again, I don't want to wade too far into that because that right now is probably about the area of my expertise. But definitely, it's something you should know about as a passive investor, and it's definitely a question that's worth asking for sponsors because a lot of times this can be a major expense, and maybe the deal was kind of marginal to begin with, and now you've got this fairly sizable expense that no one accounted for, and it actually significantly reduces returns. So,
but if you, on that same note, right, even if you took bonus depreciation, that's 5 and 15 year property. If you hold it for 15 years, I'm not a CPA, I might be wrong somewhere in here. I believe that 15 year schedule is fully depreciated. Yes. There shouldn't be recapture on that. And you didn't bonus depreciate the 27.5 year property. So,
So that's the way, again, the best way to, and some people say, well, that's not fair. The IRS wants it back. And I think, well, it seems fair, right? They're willing to give you all this benefit up front. And if you don't use it, it seems like you should.
Not if you don't use it, if you didn't earn it because you didn't hold it long enough.
Correct. Yeah. So something to know in this that, depreciation is based on these schedules. And then if you are not holding the property for the length of that schedule, then the IRS will, situation depending, but they're probably going to come back asking for some of that money back. And that will be paid out of the sales proceeds of the property before you as an investor receive distributions. That we should probably get a CPA sometime as a guest on here to talk a little bit more about that. But that's a high level. I think that's just as to try to arm an investor with what they would need to know going into it. I think it's probably.
I think it's a good place to wrap it up for now.
Sounds good. Well, everybody, we appreciate you listening. If this was beneficial, let us know. Send us an email. We got a contact page on the website. Also, Adam offered a free cookie, depreciation at wealthindependencepod.com. So let us know if you made it this far. And if you like the episode, thumbs up, positive review on Apple Podcasts. We appreciate all that. Let the computers know you're enjoying this. But with that, we'll get out of here and we'll catch you on the next episode. Appreciate you listening. Just remember, where freedom leads, where wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.